The past few years have been challenging for investors. Most major indices have seen declines year over year, and the Federal Reserve has been steadily increasing interest rates for quite some time. Despite the grim economic forecasts, seasoned investors like Warren Buffett know how to navigate these turbulent waters. In this article, we'll explore Buffett's investment strategies, his advice for weathering economic storms, and how you can apply these principles to your own portfolio. Whether you're a seasoned investor or just starting out, these insights will help you make informed decisions in uncertain times. The current economic landscape. The Federal Reserve has been tightening financial conditions, and there's no sign of this trend slowing down. The collapse of Silicon Valley Bank and the subsequent shakeup of regional banks have added to the economic turmoil. Historically, such aggressive interest rate hikes have often led to deep recessions. Unfortunately, this is the reality investors must face in 2023, and the outlook isn't improving. The Fed has signaled that higher rates are likely to persist in the near future. The impact of rising interest rates. While the primary goal of increasing interest rates is to curb inflation, there are other significant effects on the economy. Higher borrowing costs. As interest rates rise, the cost of borrowing increases for businesses and consumers alike. This can slow down economic growth as companies cut back on investments and consumers reduce spending. Reduced consumer spending. Higher interest rates mean higher mortgage payments, car loan rates, and credit card interest. This leaves consumers with less disposable income, which can lead to decreased spending and slower economic activity. For investors, these changes have three major implications. Bond prices. Decline. As interest rates rise, bond prices fall. This makes bonds more attractive to new investors as they can lock in higher yields. Higher returns on savings. Savings accounts and other low-risk investments become more appealing as interest rates rise. This can lead to a shift in investor behavior, with more money flowing into safer assets. Stocks take a hit. Stocks, which are inherently riskier, now have to compete with higher risk-free rates offered by bonds and savings accounts. This can lead to downward pressure on stock prices. Warren Buffett's timeless investment strategy. In times of economic uncertainty, it's wise to turn to the strategies of the world's most successful investor, Warren Buffett. His approach to investing can be summarized in three key steps. Identify companies with strong competitive advantages. Buffett looks for businesses with durable competitive advantages, or moats, that protect them from competitors. These companies are often market leaders with strong brands, loyal customer bases, and efficient operations. Buy at an attractive price. Buffett emphasizes the importance of buying stocks when they are undervalued. This means waiting for the right opportunity to purchase shares of a strong business at a price that offers a margin of safety. Hold for the long term. Buffett is a firm believer in the power of long-term investing. Once he buys a stock, he holds on to it for years, if not decades, allowing the company's value to compound over time. The importance of temperament. Beyond these three steps, Buffett stresses the importance of temperament in investing. In his 1996 letter to Berkshire Hathaway shareholders, he wrote, "You should entirely avoid owning stock if a crashing market would lead you to panic and sell." He also noted that selling well-performing businesses during market downturns is usually a bad decision. To illustrate this point, Buffett often tells the story of Robert Woodruff, the business genius who built Coca-Cola. When asked when it might be a good time to sell Coca-Cola stock, Woodruff simply replied, "I don't know. I've never sold any." Buffett's takeaway is clear. Even if you pick the right stocks, you can lose everything if you lack the patience and discipline to hold on to them during market volatility. Buffett's three philosophical benchmarks. Buffett's investment philosophy is built on three key principles. Attitude toward the market. Buffett advises investors to adopt a long-term mindset and avoid being swayed by short-term market fluctuations. This approach is detailed in Benjamin Graham's The Intelligent Investor, a book Buffett considers essential reading for any investor. Margin of safety. This principle involves buying stocks at a price significantly below their intrinsic value. This provides a cushion against potential losses and increases the likelihood of long-term gains. Viewing stocks as businesses. Buffett encourages investors to think of stocks as ownership stakes in real businesses, rather than mere pieces of paper to be traded. This perspective helps investors focus on the underlying value of a company, rather than its stock price. Passive investing. Buffett's recommendation for most investors. For those who lack the time, patience, or expertise to pick individual stocks, Buffett recommends passive investing through index funds. He believes that most investors would be better off investing in a low-cost index fund that tracks the S&P 500 rather than trying to beat the market through active stock picking. In a 2017 interview, Buffett explained that investing in an index fund is essentially a bet on the long-term success of American businesses. He recounted how a $51 million by 2017, assuming dividends were reinvested. The only thing an investor needed to believe in was that America would continue to prosper. Buffett's advice is particularly relevant in 2023, as market volatility and economic uncertainty make it difficult for even seasoned investors to pick winning stocks. By investing in an index fund, you can gain exposure to a diversified portfolio of companies without the need for constant monitoring or market timing. Buffett's bet against hedge funds. In 2008, Buffett made a $1 million bet with Protégé Partners, a hedge fund firm, that an S&P 500 index fund would outperform a portfolio of hedge funds over a 10-year period. By the end of 2016, Buffett's index fund had gained 7.1% annually, compared to just 2.2% for the hedge funds. The bet was a clear demonstration of the power of low-cost, passive investing over high-fee, active management. Buffett's victory underscores the importance of minimizing fees and expenses when investing. Over time, even small differences in fees can have a significant impact on your returns. By choosing low-cost index funds, you can keep more of your money working for you. Investing. During inflation, Buffett's advice. Inflation is one of the biggest challenges facing investors in 2023. Rising prices erode purchasing power and can lead to higher interest rates, which in turn can weigh on stock prices. However, Buffett has some advice for navigating this difficult environment. Focus on companies with pricing power. Buffett recommends investing in companies that have the ability to raise prices without losing customers. These businesses are better equipped to maintain their profit margins during periods of inflation. Examples include companies with strong brands, such as Coca-Cola and Apple, which can increase prices without significantly impacting demand. Look for capital-efficient businesses. Buffett also favors companies that require minimal capital investment to grow. These businesses can generate higher returns on invested capital, making them more resilient during inflationary periods. Tech companies, for example, can often scale their operations with relatively little additional investment, compared to capital-intensive industries like manufacturing. Invest in yourself. Finally, Buffett believes that the best investment you can make is in yourself. By improving your skills and increasing your earning potential, you can better withstand the effects of inflation. This might involve pursuing further education, learning new skills, or starting a side business. Why Buffett avoids gold. Many investors turn to gold as a hedge against inflation, but Buffett is not a fan. He views gold as an unproductive asset that doesn't generate any income or value. Instead, He prefers to invest in businesses that produce goods and services, generate profits, and grow over time. Buffett's reasoning is simple. Gold doesn't do anything. It just sits there, and its value is entirely dependent on what someone else is willing to pay for it. In contrast, a well-run business can generate profits, pay dividends, and increase in value over time. The role of interest rates in investing. Interest rates play a crucial role in determining the value of investments. When rates are low, future earnings from investments are worth more, which can drive up stock prices. Conversely, when rates are high, the present value of future earnings decreases, which can weigh on stock prices. Buffett has long argued that equities are the best place to be for long-term investors, even in a high-interest rate environment. While bonds may offer higher yields when rates are high, they lack the growth potential of stocks. Over time, equities have historically outperformed bonds, making them a better choice for investors with a long-term horizon. Final thoughts. Staying the course. In times of economic uncertainty, it's easy to panic and make impulsive decisions. However, Warren Buffett's success is a testament to the power of patience, discipline, and a long-term perspective. By focusing on high-quality businesses, maintaining a margin of safety, and avoiding emotional decisions, you can navigate even the most challenging market conditions. Whether you choose to invest in individual stocks or opt for a low-cost index fund, the key is to stay the course. As Buffett once said, the stock market is a device for transferring money from the impatient to the patient. By following his advice, you can position yourself for long-term success, no matter what the market throws your way.